You are listening to ESG News and Views from the Conference Board.
Hello, everyone. This is Paul Washington, Executive Director of the Environmental, Social, and Governance Center here at the Conference Board. The ESG Center focuses on corporate governance, sustainability, and citizenship. I'm really thrilled to be joined by John Wilcox, Chairman Emeritus of Morrow Sodali, the global corporate advisory firm. During a career in corporate governance spanning, just say decades, John Wilcox has served as Senior Vice President and Head of Corporate Governance at TIAA-CREF, one of the world's leading private pension systems, as well as Chairman of Georgeson & Company, the U.S. proxy and investor relations firm. If there's a governance organization, John has probably served on its board or on a committee. He's also a prolific author. Most recently, John released The Evolution of Corporate Governance, which is a collection of articles and essays that provides a picture of how corporate governance has evolved over the past few decades. It's really a fascinating read. And I'm really thrilled to dive deeper into both the evolution of corporate governance and the future of corporate governance with John Wilcox. We met quite some time ago, John, at one of those conferences that we all used to go to. You came from the investor side, I came from the corporate side. And, meeting you is just one of the great moments in my career because I thought, here's a guy who actually knows what he's talking about. This was a real thrill. So I'm delighted to be joined by you today.
Thank you, Paul.
Look, it's a little difficult to talk about where we're going without talking about where we've been and where we are. So let's begin tapping into your expertise about what's changed in the past 30 years in corporate governance in terms of the board, shareholders, and the interaction between the two. Let's start with the board. What have been the main trends over the past decades in the role of the board? How has it changed?
Well, before I answer that question, let me just tell you a little bit about what the experience of writing this collection, or bringing together this collection, was like. Because each of the essays was written at the moment when the issues were critical. And so it's a kind of real-time look at the evolution of corporate governance. And as I collected these essays, there were a lot I didn't include, but what I found was that there were actually some very significant transformational factors that had affected the first 30 years of governance in the same way that we're now seeing and discussing openly the transformational changes that are affecting governance today, ESG, corporate purpose, etc., things that you and I will discuss a little bit later. And those transformational forces that go way back that were changing the landscape of governance were such things as the Williams Act regulating tender offers, the hostile takeover era in the 80s, proxy contests, the rise of the poison pill takeover mechanism, which Marty Lipton created, and also during that whole period, very significant changes in shareholder demography and the rise of asset managers. In the 70s, when I first started working in this area, individual shareholders were the only ones around. We now know that we have these very large collective investment pools that have a very different role. So living through all of that, you will see in the course of these essays recognition of the impact on the way that companies and shareholders really felt about each other. And during these first 30 years, shareholders were really outsiders, and the board of directors and the management often viewed them as the enemy, with some justification. And at the same time, there was also the Milton Friedman idea of shareholder primacy, which made companies very focused on Wall Street and on financial results rather than on stakeholders as we do now. So To answer your question with the what happened to the board of directors, in the early days, as we all know, the qualities of the board of directors that were really valued and focused upon were the collegiality and the confidentiality of the boardroom. And it was deemed almost necessary for boardrooms to be closed and opaque. There was really no job definition for directors. And if you look at the very first essay in my collection, which is entitled A Struggle for the Soul of the Board, I chose to put this at the start because it's really one of the great themes of governance achievements during its first 30 years, that it was really all about getting a greater understanding of the role of the board of directors, greater transparency. And there's an essay on page 123 entitled From Sunlight to Electric Light, which focuses very closely on making the board of directors more transparent and finding out what's going on. So getting away from that confidentiality, having a clearly defined job, bringing sunlight, bringing electric light into the boardroom, also engagement, direct engagement between directors and shareholders, which was certainly a no-no in the early days and is now widely accepted. And I'll go a little bit to an extreme and say that one of the things that I have advocated for many, many years is a report from the board of directors, which I refer to as the directors' discussion and analysis, similar to the MD&A, the management discussion and analysis, because I think that directors have such an important job nowadays, and it's recognized, that they should have their own report. So nobody likes that idea, but I still keep advocating.
Well, we're seeing something that's closer to that. And I think you're talking about the demystification of the board externally with investors, but even internally within companies. I think there's still some distance to go there, but you are seeing it in a few ways, I think, right? You're seeing it in letters from the lead independent director or the chair of the board about what the board's been doing in the past year. Like, what has the board been doing in terms of its oversight of the company's strategy? What has it been doing in terms of improving its own governance, in terms of its composition? So you see that often in letters to the shareholders that come from the chairman or the lead independent director. And then I think you're seeing it in expanded disclosure within the proxy statement and some other areas. But, and I think there's maybe a third area that we're seeing it a bit now, is that directors are getting out and meeting not only with investors, but they're also meeting with employees these days, especially in the wake of the killing of George Floyd. Many directors have been engaging with employees around issues like racial equality, racial injustice, in a way that never happened in the past. So I think there's probably some distance to go, and maybe people will be embracing your director's discussion and analysis. But I think there's some change that's happening in that front.
I couldn't agree more, Paul. Absolutely.
Yeah. And now you mentioned at the outset that shareholders were kind of outsiders and a bit of the enemy. But the role of shareholders and how they fulfill that role has actually also evolved in the last 30 years. Do you want to talk a little bit about your thoughts on how that's changed?
Sure. Well, obviously, the changing shareholder demographics have been critical to the role of shareholders. As I said earlier, in the 70s, we still had the majority of shares held by individual shareholders, and they were ones who actually read annual reports and then purchased shares and were generally long-term holders. And the role of intermediaries was mainly custodial. And then we saw the rise of mutual funds and eventually these big indexers. And the rise of those institutions has been critical to the evolution of corporate governance. I trace the start of governance really to the year 1987. Actually, ISS, the Institutional Shareholder Services, was started, I think, a couple of years earlier. But 1987 was the year in which we had the first institutionally sponsored shareholder proposals. And those were presented by CalPERS. Before that, proposals were really gadfly proposals. And the very small resubmission thresholds that were part of Rule 14A8 were a reflection of the fact that these were resolutions that were not expected to score high results. And it was really, in a sense, treated almost like a playground for individual shareholders. And so the evolution from gadflies to today has been very, very dramatic. One of the other interesting things about the institutional shareholders is that they have done something, particularly in recent years, that corporations were reluctant to do, and that is sort of self-regulation. I can remember hearing many, many complaints on the part of corporations that they were very, very heavily regulated and institutions were not, and they felt that this was unfair. But in recent years, we've seen the evolution of stewardship principles and sort of self-regulation by institutions. In the UK, which has been a leader on this trend, there has been some regulatory push behind this. But in the US, it's been almost self-defining, and some of the most aggressive of the institutions, such as BlackRock, whose CEO, Larry Fink, has published these annual letters to CEOs, which are very closely followed and which have a real leadership role for institutions and have had a very big impact on corporations as well. So there's been a very big change from the outsider enemy to the leadership role and the guidance role that these largest institutions now play.
I think that's right. And I think that if you're within a company and you're making a decision on almost any significant topic, you will look at how that decision will play out in light of your major investors' voting policies and so forth. It's definitely one of the criteria that companies look at. And I think what's gone along with that is an increased capacity of investors to evaluate corporate behavior in areas. When the Say on Pay vote came along, institutional investors built their capabilities to evaluate executive compensation. They've built their capabilities to evaluate the composition of the board. They've built their capabilities to evaluate environmental and social aspects. I think there's a challenge for investors to be able to have the capabilities to evaluate how companies are doing in depth in all of these areas, because every company is a little different. But I think you've definitely seen a beefing up of the resources there that investors are devoting to these areas. And along those lines, so you see this evolution of boards becoming more transparent in many ways, more accountable. You see shareholders taking more of a stewardship role. How has that affected the dynamic between boards and shareholders? Obviously, directors now meet with shareholders every now and then, but what else has really happened in terms of the dynamic between boards and shareholders?
Well, one of the essays deals with BlackRock and how to get along with BlackRock. I interviewed Michelle Edkins, who's been there for many years and has a long history as a governance leader. One of the things that she said, and she's continued to say it, is that she wants every corporation in their portfolio to reach out to BlackRock over the course of a year. Now, they have thousands and thousands of companies, and that doesn't mean that they're actually going to meet with all of them or engage with them, but they want that initiative to be made by the corporations. And they will then meet with those where they think a meeting is needed or where it will be productive. And one of the things that impresses me about the way that these very responsible stewardship teams operate is that they are respectful of individual companies. And when they meet with them, they listen to what the company has to say. And even if a company is out of compliance with best practices or standards or the types of checklists that are used often by proxy advisory firms to evaluate governance in particular, some of these institutions will listen to the backstory of the corporation on what they're actually doing to try to correct those non-compliant practices, or what is the strategic justification for those non-compliant practices. And I think that type of approach is one that we're going to see much more of in the future. It's the kind of comply or explain, or sometimes what I refer to as the comply and explain approach to governance, in which we recognize that no two companies are exactly the same, and that a strict compliance approach is going to try to force every company's into a single framework, and that just doesn't work. So increasingly, I think the interaction between companies and shareholders is going to be good for companies in the sense that their individuality will be increasingly recognized, and they will have the opportunity to put strategy first and business considerations first rather than compliance with external expectations. So I think this is something that is going to be accelerated by the current focus on ESG and on corporate purpose and sustainability. The recognition of these factors as being material to the financial performance of companies is something that will broaden the discussion beyond the usual compliance framework.
Got it. So then let's talk a little bit about regulation, because what you were just discussing there was how investors are approaching companies in a call it a private ordering way. So we have our policy, we have our framework, company, comply and or explain why not. Well, how do you view regulation in this area? Every time an idea has surfaced, sometimes from outside the United States. Let's say it was on say or on pay, the ability of shareholders to vote on executive compensation, or the idea of proxy access, the ability of shareholders to place their candidates in the company's proxy statement in the director election process. There's been a huge battle royale between corporations and others, with those who say, yes, this idea needs to be mandated across the board in prescriptive regulation. Companies say, oh no, leave it to private ordering. And in the middle are those who have sort of supported comply or explain, or let's say principle-based rules, which leave companies with a fair amount of latitude. When you're looking at regulation in this area, do you generally then fall into the sort of comply or explain or principle-based disclosure camp? Just curious.
Yes, I do. And I think that the regulatory standard that is most critical is the one that relates to materiality, that mandates disclosure of anything and everything that is material to the company's performance and to an understanding of the company's risk profile and its earnings potential. But at the same time, I think you need to recognize that those who are most able to judge what is material are those within the company, which is why the comply or explain approach is the one that I think ultimately we're going to come around to. And I would refer you to some recent speeches made by acting SEC Chair Allison Lee, who has said very clearly, companies need to tell their own story, their individual story. And it seems to me, if I'm understanding her correctly, that her approach is much more about an approach to disclosure that enables companies to tell the story that they need to tell, including all of the material items, as opposed to a compliance approach where the company looks at what the regulator asks for and delivers that type of disclosure. So I think we're going to move in that direction. It's been helped, I think, a little bit by organizations such as SASB, the Sustainability Accounting Standards Board, that has in fact come up with a very comprehensive matrix of materiality with respect to climate change. And so the more we emphasize materiality as a regulatory mandate, but allow companies to make their own judgments and explain what those judgments are with respect to what is material to them individually, I think will improve the situation.
Right. So it's an emphasis on effective communication, not just compliance with
Yes.
a prescribed framework. So let me turn to some of the hot button issues today and hear your views on them. So there's a lot of talk about stakeholder capitalism, the notion, and there are various ways of looking at stakeholder capitalism, but the fundamental idea is that companies need to focus not only on the economic interests of their stockholders, but that they need to focus on the welfare of their various stakeholders. And that includes employees, customers, society at large, business partners, and others. And that focus needs to be not just that these are inputs to creating value for stockholders, but in some cases that they're actual important outputs, that these are important constituencies to serve, again, for the long-term health of the overall, economic system and overall society, that it's actually okay to think about the welfare of these other constituencies, these other stakeholders. So, what's your take on the state of stakeholder capitalism and where that's going?
I'm not happy with the term stakeholder capitalism, and that's really for one reason. And that's because it implies a sort of zero-sum game between stakeholders and shareholders. Shareholders are stakeholders, and I think if you don't separate the two, and if you recognize that the interests of what are now collectively referred to as stakeholders separately from shareholders, that is employees, suppliers, the communities that are affected by the company, sort of economic environment that is affected by the company. That these are things that well-run companies have been paying attention to all along. I think what we're seeing is more an evolution away from the Milton Friedman doctrine of shareholder primacy, which was really Wall Street primacy, in my view. What companies were doing when they were adhering to Milton Friedman's idea that the company only owed a responsibility to shareholders and shareholder return, that was really a way of saying that companies needed to pay attention only to stock price, quarterly earnings, and basically what Wall Street wanted to hear about. But we've learned with some very vivid examples is that a business enterprise's risk profile must include factors beyond those that are measured financially. And it's been a very important lesson. And, in the old days, there was this sort of idea, real businessmen only paid attention to the bottom line. Well, what we're now recognizing is that real businessmen pay attention to all aspects of the enterprise that they are in charge of. And that includes women as well as men. That includes employees. That includes suppliers and the supply chain. There have been innumerable examples of companies that have nearly gone out of existence because of governance failures, cultural failures, ethical, and all kinds of issues that are not measured in financial terms, that are not part of the traditional financial audit. So I think separating stakeholders from shareholders, perhaps it's a good transitional way to teach what has always been understood by well-run companies, that you've got to pay attention to everybody in the enterprise and everybody affected by the enterprise, and customers obviously as well. But I think ultimately we don't want to differentiate between shareholders and stakeholders.
Right. Another way to think about that is that you're not only focusing on the economic interest of your stockholders are people too, right? Ultimately. And that they have other interests besides just their narrow economic ones. They're also members of society. So perhaps another way to cut it is to say, let's look at the broader interest of our stockholders, which will in fact match the interest of your various stakeholders.
Right. And I think one of the problems here is that it's relatively easy to have metrics for financial performance. And this is what people are trained to do when they go to business school. It's quite difficult to measure these non-financial, intangible risk factors and opportunities also, performance opportunities. And so we're grappling now with retraining Wall Street to figure out how to factor these issues into their evaluation of companies. And it's not easy. And so that's still an open question as to how that's going to work. There's also a problem of making companies comparable to one another. Comparability is something that both companies and institutional investors and shareholders want. They want to be able to compare one company to the other. And that was relatively easy to do when you were looking only at financial metrics. It's much more complicated when you're dealing with these intangibles that are still very material to the success of the company and to its financial health. So we're in the process of trying to figure out how to do that, and it's quite a challenge.
Right, because each company is different, and actually, as you know, while some of the metrics may be the same, financial metrics may be the same, the accounting behind those numbers is awfully different. How you book revenue at a media company, for example, is different from how you book revenue at a oil and gas company or others. It all depends on the type of business. So even sitting behind those financial metrics is often a different approach in accounting, and that's only vastly compounded in its complexity when you're talking about non-financial metrics. So let me turn to another hot button issue, which is the role that business leaders are playing these days in taking a stance on social and political issues. Several years ago, we saw a wave of corporations taking a public stance on LGBTQ issues. And then since then, there have been a cascade of other issues that employees and customers and sometimes investors are looking for companies and their CEOs to take a stand on, whether it's on climate change or most recently in terms of the presidential election and the Capitol riot. So what's your take on the role of corporate leaders taking stands on social and political issues? Is it advisable? Is it sustainable? Just interested in your views.
Well, my answer to that question is that I think that corporations should lead by example. They should exemplify what they want to see in society. That doesn't necessarily mean that they have to speak out on every particular issue of the day, but it means that they have to practice what is right and what's in the best interest of all of those they serve, all those stakeholders. And I think that with respect to political funding, I'm in favor of the French approach, which is to disallow it completely for corporations. And with respect to lobbying and so forth, I think that transparency is the answer. And even, I think there's a differentiation between direct and indirect financings, so that if a corporation is a member of one of these membership organizations, such as the Chamber of Commerce or industry groups or whatever, and they provide funding to them, they should be aware and should disclose the degree to which that funding is used for lobbying, and should not allow funding for political candidates. That would be my preferred way. But I think it's a larger issue. I think when you're dealing with leading by example, I think that the CEO's role is one that we need to take a hard look at, and CEO pay. Throughout this book of collected essays, you will see that I have referred a couple of times to the difference between the leadership style of Reginald Jones, who was one of the creators of GE, and his successor, Jack Welch, perhaps the more famous of the two. But Reginald Jones represented what I believe to be the correct model of really responsible leadership, whereas Jack Welch represented the imperial CEO leading from a position of privilege. And I think we need to get back to the Reginald Jones model. And I think that's starting a little bit. I know the current chairman of the Business Roundtable has some of those qualities. I also think we need to pay attention to the problem of executive compensation. I consider myself to be a big fan of Peter Drucker, the late management consultant and very much revered. He hated high CEO pay, and he felt that it was very damaging to enterprise team spirit. And he suggested that CEOs should be paid only 20 to 30 times the pay of the average employee, and we're up 300, 400, whatever it is now. I think we need to address that problem. And that is a problem that's really been created by boards of directors. So here again, there's a lot of work to be done. But I think that leading by example, rather than making a public statement about every particular issue of the day, is the best way for companies to lead.
Right. I think I think what you've done there is you've distinguished between social issues and political issues. So the social issues definitely lend themselves to leading by example. Some of the political issues, political contributions, I think a lot of companies would say, well, we just can't disengage when it comes to giving, whether directly by the company at the state level or through, and keep in mind, they're employee-based PACs at the federal level. But I think I think the notion of on social issues leading by example has a lot of merit to it. Let me turn to two final questions in the time we've got. Let's first talk about the workforce. Last May, when we asked companies at the outset of the pandemic what were the board's top priorities, workers were at the very top, just after liquidity. And this is when companies were worried about their very survival. Workers were number two after liquidity. Then last September, when we at the conference board convened investors representing $12 trillion in assets under management and what they wanted companies to do about racial, health, and economic inequality, the overwhelming answer from major institutional investors, and these are mainstream investors, was they wanted companies to focus on their workforce. That the best way to address those profound social issues was to focus on their own workforce, getting their own house in order, if you will, leading by example, perhaps in your words. And in January, when we put out a report on human capital management and disclosure and talked about how it can really drive long-term value for companies with a lot of specific suggestions about how boards can do that. So, and they're the new SEC rules, on human capital. So there are a lot of reasons to think that boards are now in a position where they can focus on the workforce in a way that they haven't in the past. In the past, it's often been episodic, whether it was with Me Too or a scandal or the aftermath of a merger. There's a lot of focus on the workforce. The pandemic has caused a focus on the workforce. But now the question is, can boards really focus in a sustained and strategic and systematic way on the workforce? Or will we go back to the time when, okay, the workforce, that's really up to management and the CEO to worry about. Let them worry about it. We as the board have to worry about plenty of other things. So what's your thinking about whether and how boards might, and should they, focus on the workforce in a sustained way?
I think they have to. I think board of directors have to focus on that. In fact, what I would recommend to companies is that they create a human and capital management committee that absorbs the comp committee. Because I think that issues such as executive compensation and CEO succession are issues that should always be evaluated in terms of a company's overall human resources policies, and should be very open and should be rooted and explained in terms of those policies that affect all employees. In my view, that's the only way to really run an effective business enterprise, where everyone in the company understands the compensation system and the system for advancement, career development, that it's a whole, that it's a responsibility of the board of directors, and that the succession of people within the company is one that follows a pattern of merit and achievement that everyone can recognize and agree with. So, and I think issues such as culture, which is one of those issues that is increasingly discussed with respect to corporations. Corporate culture is the responsibility of the board of directors. And culture is something that must work as part of human capital management, ethics, sustainability, which is often now thought of slightly narrowly in terms of climate change and the threat to sustainability of climate change. I think sustainability has to do with the sustainability of the enterprise, the group of people working together, as well as the business and the competitive external factors that businesses have to deal with. So I absolutely think that human capital management is what companies are really all about. And so it should certainly be at the top of the list of responsibilities of the board of directors.
Got it. Yeah, and it definitely helps when you put executive compensation and culture in that broader context. Well, we'll see whether companies move in that direction. We do in our latest report recommend that they take a close look at how they're allocating responsibility for overseeing the workforce among committees, including possibly establishing a committee devoted to that, which would include compensation, but not just be focused on it. So we'll see. So looking ahead, there's a lightning round question. What's the most important advice you have for CEOs, boards, and shareholders right now? And given your perspective, based on your decades of experience and all you see going on, the confluence of your experience and the multiple issues we're facing, what's the number one piece of advice you have for each of those?
Well, I think one of the topics that we've already discussed at length is the idea of corporate reporting and communication getting away from a compliance exercise and into a more candid and integrated also, because I'm a fan of the integrated reporting movement, but a kind of holistic approach to communicating what this business is all about, how it makes money, how it's structured, how it's run, what its values are, what its culture are, so that getting away from disclosure and corporate reporting that follows external guidelines and one that is focused on explaining all of the material elements that make the business run and that are critical to its future and its strategy. I think that kind of communication is a top priority. I think another priority is to continue for corporations to continue to wean themselves away from their subservience to Wall Street. The stuff that we've been hearing about just this week with respect to GameStop and these short sellers, and which has become highly politicized. The idea that the stock market is being driven by social media, and there's an uprising of little guy investors that are finally winning out over sophisticated Wall Street professionals. I mean, that's not healthy for companies. And I think we're going to have to pay a lot of attention, and regulators are going to have to pay a lot of attention to whether or not the stock market is something that is doing what it was originally intended to do, which is to value companies. This type of trading that we've seen has nothing to do with the fundamentals of the company whose stock is being used by like poker chips. Mm-hmm. This is a form of gambling and tail chasing. This is a problem for companies, and I'm worried that it means that we're going to have fewer companies that want to go public for the right reasons. So I think weaning ourselves from Wall Street and getting that the operation of the stock exchanges and trading regulated more effectively, that is a challenge. Executive compensation is a third challenge. It's really gone over the top. And as I said earlier, I'm an adherent of the views of Peter Drucker that to achieve the kind of teamwork that is necessary for business enterprises to be healthy requires a much more uniform approach to compensation, or I should say, unifying approach to compensation. It's going to be very difficult to go there. I think that the excesses that we've seen are part of a trend that started way back with the allowing the stock exchanges to go public, and having investment banks go public and start to do what they do with public monies rather than with their own partnership funds. It was kind of opening of Pandora's box, in which these huge escalations in compensation were something that people started to compete for, and it overwhelmed the kind of values that that companies ought to exemplify. So we've got to do something about executive compensation. That's the third big issue of the day, I think.
Great. Thanks so much. And I would note that when you talked about companies weaning themselves from subservience to Wall Street, you're not talking about detaching themselves from the investors whom you regard as useful stewards of and critical stewards of an organization. It's really weaning themselves from over focus on the current stock price, I think. And
That's right. Yes. Right. It's also a question of foregoing short-term focus, really focusing on long-term performance and sustainability. And I know that the Conference Board has done a lot of work on the issue of short-termism, and there are many people who believe that quarterly reporting is something that should be examined very closely. I think the companies should be looking at their numbers quarterly, but shouldn't be giving guidance. That's where I come out on that issue. But I think that long-term is obviously important if we're going to deal with these really significant and very material problems such as climate change and human capital management that should be at the top of the agenda for corporations.
Right. And let me just pick up on one final thing before we conclude that you said, and which is it's actually, we are seeing a decline in the number of public companies in the United States as more companies go private. And, that raises a serious question, because public companies are required to have a high degree of transparency. Transparency can lead to trust. It can lead to trust in your economic system. And so if more companies find it more advantageous to go private or never to go public at all, that's a real challenge for our society. There are challenges, as you mentioned, with executive compensation with public companies, but it's still a terrific model if done well.
I agree.
So, John, thank you so much for an amazing conversation. Thank you all for listening. A link to John's book, The Evolution of Corporate Governance, is available on this podcast webpage, as are the reports that I mentioned, particularly those relating to human capital. Those are definitely worth reading if you get a chance. You can find additional podcasts, webcasts, and other items relating to corporate governance, sustainability, and corporate citizenship by visiting ESG News and Views at conference-board.org/blog/podcasts. So thanks again, John. Thanks again, everyone, for listening today. Take care.
This has been ESG News and Views from the Conference Board.